Looking at the assumptions for Hasbro on the income statement, looking at royalties in particular. What are royalties? That are dollars that must be paid based on sales of some item that we've purchased, like a game or whatnot, that is paid to the creators in terms of royalty. And would we expect that to be related to sales? Yes, we would. Now, it could vary over time, of course, and we see here here's our percentage of sales. So we can see fairly steady, average 7.9%. I actually have a median here as well, and also to give us an idea of degree of variation, of coefficient of variation, which is standard deviation divided by the average. So we can see here for royalties, the median is actually equal to the last year, and so we will go with, given it's fairly steady, we'll go with the percentage of sales here. Just change the, you can see that, and that's the last year figure, which is also the median. Next we've got product development expense. That's what you can see here, fairly consistent over time, and actually the average and median are the same values. So there is an uptick, so we'll go with percentage of sales on this, given numbers here, increasing just a little bit above the average, going with that more close to that last number there, 5.31%. Advertising expense, we can see also that it's been pretty consistent against sales, with a downward and ticking back up a little bit. So we'll keep it pretty close to this figure here. Again, let me just so we'll go with 9.5%. So there's a little bit of an uptick here. For amortization of intangibles, amortization is like depreciation, except it's for intangible assets. And we can see the numbers here, which are declining over time. And what is being amortized would be down in the balance sheet. The other intangibles, which we can also see are going down over time. So I did look at the 10K, and let me pull that up right quick, and I've got some comments in here that we can quickly find the intangibles. And here's some discussion about the intangibles. On the next page, it actually gives us the anticipated amortization for the existing intangible assets, 17 million actually, and then 29 million. So the question is, do we expect them to add additional intangible assets? So just a little bit of work in that regard. I'll try to do this fairly quickly. So let's go down here a little bit. All right, so I want to try to figure out fairly quickly to what extent have they bought new intangible assets during the last 5 years, or last 4 years anyway. And we're kind of backing into things here, because these intangible assets in the year, and all these numbers are given to us. We have the amortization expense from above that we briefly saw. These numbers came out of the balance sheet, and I'm assuming that they didn't sell any intangible assets. That would be fairly uncommon that they would sell intangible assets. So we can actually back into the purchases of intangible assets for these prior years. So again, this is a historic to give us an idea of what might happen going forward. So just thinking about this, how do we get the 375,990, 999 I should say? That would be equal to the prior year figure plus any purchases minus the depreciation minus the intangible sold to get this figure. So given that I have this number and all these other ones here with the assumed 0, we can do the following. So this would be equal to our bottom line figure, subtract out anything that we would add. So that actually we would add the amortization, and then we would add the 0. So that's our estimate of purchases for this particular year, and I'll double check this, make sure I did it right. So equal this number, it's that one, minus amortization, and typed in the wrong thing there, minus the amortization, minus that, Okay, and that does equal, and I'll just do, actually I'll change this a little bit. We'll get a little check here, will be a true or false. Does it equal this? And it does. Okay, and I'll just pull this across. So again, what I'm trying to do is determine, well, to what extent they've been purchasing new intangible assets, which would again be like copyrights, patents, those type of things. And a big purchase here, but the last, I think the last 2 years, basically zero. That actually, I guess, looks like they actually did sell some, or write off some intangibles there. So we're going to go with, for the amortization expense, that is, we're going to go with these figures here, the 29 and the 17. And I've got these over here. So amortization of, based on the 10K, 29, and the 17. Next we have program production cost amortization, a somewhat unusual item. I say unusual in that I'm not sure exactly what that is, so did a little bit of work here prior to on the 10K, and here we can see a brief description. What they're amortizing is TV production, I'll say TV or film production costs over time, as opposed to, so they can't just write those off as they're doing them. Here's another little bit. Incurs cost of production of television program and motion pictures. So a description of what that is. There's not a whole lot of information that they do mention down here for existing 22690, but they also could be doing new programming. What I elected to do here is hold this constant at the prior year. In other words, it was kind of pretty difficult to come up with a firm percentage. We're going to go with a fixed prior year. We're going to, in other words, use this number here as our assumed going forward for the next 2 years. The selling, distribution, and administrative expense we're going to do in class, and then that takes us to interest expense. So what drives interest expense? That is based on the amounts borrowed as well as the interest rate that's paid. And in this case, in terms of items that would draw interest, I say draw interest, that pay interest on, that would be short-term borrowings, long-term debt, and also a current portion of long-term debt, and also long-term debt. So we have these three items here that'd be paying interest on. For the interest expense, we'll take an average outstanding debt for the year, and we'll multiply that by some interest rate. We're going to use an interest rate of 5.7%. So where did that come from? Well, one thing we could do is look at the long-term debt. This is off of the annual report. I just went ahead and pulled it up. We can see these rates here. We could take some weighted average of that. And in addition to that, we could look at what is the interest expense as a percentage of outstanding debt, average outstanding debt. So that's what I have here actually. So notice I'm taking the interest expense and dividing by the outstanding debt. I probably should be using an average there, but we'll go with these numbers here. So you can see it's fairly close to 5.7%. So we'll go with that 5.7% on the interest rate there. For interest income, that's income earned on cash balances, basically. Somewhat similar to interest expense. We're going to assume that that's a percentage of the average, but for cash in this case. And let me just show these right quick. So we're going to take the percentage of average cash for the year, and I'm going to use a 0.75% rate as an interest rate on basically that we're earning on those. Now, where did that come from? Well, I know it should be fairly low, just in general based on current interest rate conditions. But over here, I'm taking the interest income dividing by the cash balance, and you can see the rates here vary a fair amount, but most recent year about 0.7, so we're going to go that 0.75. For other income expense, we can see here the historical numbers. So it's mostly been an expense, 1 year income. We're going to assume that this is fixed, and we'll go with the last, or something close to the last year figure, a fair amount. Looking at the 10K, here's some information about what this is for the last 3 years. So it's foreign currency or foreign exchange gains or losses, and some other things there like some asset sales and whatnot. So fairly difficult to predict. It is a fairly small amount, so there's not much use to spend a great deal of time on it. We'll pick something that's pretty close to the prior year. For income taxes, we're going to assume a tax rate. Okay, so there's our tax rate. So where did that come from? Well, basically, in terms of income taxes, how they computed, you're paying tax on your earnings here. There's this above figure, earnings before taxes. So where's the 23.5% interest rate come from? I'll move over here a little bit to the right, and I've computed income taxes percentage of EBT, that is earnings before taxes, and we see obviously some variation, but 25% seems to be a pretty reasonable figure to use there. For net loss or earnings attributed to non-controlling interests, we can see the numbers are fairly small here, and these would be acts as net loss. So these are all losses actually. They're fairly small. For things that are fairly small, you shouldn't spend a whole lot of time working on them. Here we can see what I've done here. I'm going to assume fixed at 5,000, and there is a little blurb here in the 10K about non-controlling interest. You can pause if you want to read that. It does actually say during the first quarter of 2017 was acquired. There may not be anything going forward past 2017, but we'll just assume a fixed at 5,000 for that.